there's some irony with Chipotle. I would love to have Chipotles in our shopping strips. There's a lot of potential with the Chipotles. Chipotle, Starbucks, some of these really large corporates, they have a lot of building requirements. So sometimes, just sometimes, not always. Having said that, Starbucks and Chipotle would be fantastic to have in your shopping strips.
Welcome to the Physicians and Properties Podcast, the show where we teach you how investing in real estate can give you the freedom to practice medicine and live life how you want.
Doctor!
Now, here's your host, Dr. Alex Schlow.
Hello, everyone. Welcome to another episode of the Physicians and Properties Podcast. I have a question for you before we get started. Have you ever gone to a strip mall or a small shopping center and thought, man, it would be really cool if I owned this building? If you've thought that, if you thought, hey, I want to buy this building that has a Chipotle in it, then this episode is for you. My new friend, Dr. Mounang Desai, is on the podcast. Dr. Desai is an emergency medicine physician who's been practicing for 25 years. He also has experience as a healthcare executive, and he is an entrepreneur turned real estate developer. This episode, I learned so much. I'm going to be staying up thinking about this and the potential opportunities for ground up development in unanchored retail service centers. This was a really cool episode. So go ahead, leave us a 5-star rating and review if you've learned something from this episode. And if you're interested in investing, stay tuned at the end to learn a little bit more about Malabar Hill Capital and how you could invest with Dr. Desai. Without any further ado, let's get started with today's episode with Dr. Mounang Desai. Dr. Mounang Desai, welcome to the Physicians and Properties Podcast. I'm so glad to have you on the show today. How are things going?
Fantastic. I appreciate you having me, Alex.
It's my pleasure for sure, and really excited to hear more about your real estate journey and everything that you guys are working on. So really grateful for this opportunity. Do you mind kind of introducing yourself, telling the audience a little bit about yourself?
Sure. Emergency medicine, so fellow physician like many of you all. I practice, actually this year will be 25 years. I finished a residency back in 99 in emergency medicine, actually in Houston, but grew up between Louisiana, Alabama, came to Texas to do residency, and basically been here since. But very early on in my career, had the entrepreneurial bug. So worked for some very large contract management groups in emergency medicine and cut my teeth on the management side of healthcare. And then had a really incredible opportunity to build a greenfield, ground up hospital project. And that spanned a good half of my career, 15 years. Along with my partners, we were able to exit that to a large national strategic. But along that journey, I ran the emergency room services, professional services for the hospital, and inclusive to building the hospital, built freestanding emergency rooms, professional office space, imaging centers out in the community. But in that process, we started to look at things that are really impactful to real estate. So traffic count, kind of hub and spoke mechanism for where people travel and where they get their medical home, where they shop. And all of those things really contributed to how we figured out where we were going to put our medical assets. And that's really my big introduction into real estate as it would be in commercial real estate. Fast forward through COVID, having exited a lot of things in healthcare, I wanted to deploy more money into real estate. It's always been great for my portfolio, but with the cost of capital, even though it was low, there's a lot of what we call cap rate compression. Asset values are very, very high. And so there was no arbitrage. It didn't seem reasonable to buy something at a very high price, even if my capital cost was low, just to buy some. My partner and I have known each other for a good 20 years. He's a pure developer, has done many different commercial real estate assets. And I said, hey, what can we do together that's investable? And really that's where Malabar Hill was born.
What a cool introduction, and thanks for sharing that. What was it like, if you don't mind me asking, just kind of backing up towards more of the kind of healthcare executive role, what was it like transitioning from clinical medicine to then more of this healthcare executive role and managing a lot of people? What was that change like for you, those times like for you?
It was tough. As a physician who never stopped practicing, I've always practiced medicine. I practice in different facets with people who were in my group. And so it wasn't purely management. It's tough. I would say that for the clinical provider, sometimes we don't like to be told about policy or procedure or about billing guideline. But at the end of the day, medicine is a business, and you really are trying to do the right thing for the practice. And it's like wearing a lot of different hats: the hospital-based hat, the practice management hat, the compliance hat. And it's a really tough job. I enjoyed it. I grew from it. I've had the goods and the bad. I've had compliance failures, all the better for it, but it's a tough job. I would say that if you like administration, if you like a leadership role, I don't think it's a financially fruitful thing. I tell people that don't take it on because of a medical director stipend or something like that. I mean, it's a calling. You grow personally and as well as a physician clinically, fantastic. But don't take it on lightheartedly, because the clinicians, whether it be nurses or physicians you work with, that direction is extremely important.
A lot of us are probably in leadership roles or headed towards that direction. When I graduated residency from Eglin, family medicine residency at Eglin Air Force Base, I came out here to Colorado Springs to Schriever, and they were like, congrats, you're going to be the only physician that's there, and they're going to be the medical director. And I'm like, this is crazy. Go from all that support and residency to being thrown into that position. But I feel the same way. It's definitely been a balance of trying to wear multiple different hats, but also, most importantly, provide good care to the patients and try and keep all the different players happy in the meantime as well. I commend you for taking on that task. It's not something that I think I would want to do, and definitely not do long term, but I'm sure a good learning opportunity nonetheless.
Yeah, for sure.
Well, let's hop back into the real estate journey. So how did you get started investing in real estate?
First and foremost, just a little bit before Malabar Hill, I wanted to take on a passive role. And so much like my investors, alongside that, I wanted to have some kind of mailbox money, as it would be. I did invest in large funds. I invested in a junior debt fund or a mezzanine fund as it relates to new construction for multifamily. And another fund that really spoke to me was what we call power centers. So a grocery store anchor, and then there may be some other national tenants. There was a large fund in town that was investing in that type of retail product, about 250,000 square feet, kind of regional shopping districts, not shopping malls, but kind of your everyday goods and so forth. That really resonated with me. That's kind of where it started, really on the passive side. And then the following year, that's when I said, really, I want to jump into the fray, take on small projects, what we call unanchored retail shopping centers. Before I jumped in, I was building the financial models. I said, I want to go into an asset class that I know that I can exit. I didn't want to ever get over my skis, and I did not want to take on a project that I couldn't interest carry or operationally carry for any period of time when we started looking at this type of asset class.
That's really cool. These kind of smaller investments that you made, you said they were unanchored. Was that part of your process of bringing someone in to kind of be the anchor, the flagship within that strip mall or within that retail center? Is that part of the process of what you did to add value there, or what did that look like?
We don't do any acquisition. We only do greenfield projects. So in its simplest form, if you can kind of think of a master plan community, we see it more so in the Sun Belt, but they're everywhere. When you have to assemble so much land to bring home sites to fruition, 1,000 or 2,000 acres, it's very capital intensive. So scale is very important. These master plan community developers, Starwood Capital or Hines, very large national names, they're bringing together 2,000-3,000 acres, and they're not necessarily building the home, but they're selling the home sites to national home builders. Well, within these communities, there are what we call commercial reserves. As a way to amenitize those communities outside of just a swimming pool or tennis court or fitness center, they'll have these commercial areas where people don't have to drive 5 miles to get their pizza. Or there's a coffee shop, of course, medical offices, or personal care, nails, salon, hair, what have you. Those commercial reserves, in our initial phase of Malabar Hill, we bought 2-acre pad sites, as they would be called. And we built our first shopping centers, 17, 20,000 square feet. That's what we mean by unanchored. It's not necessarily what we call a big box tenant, some like a Best Buy or a large fitness concept. Most of our businesses are 2 to 3,000 square feet, and we have about 8 tenants.
Do you guys come in from the pad site and then do the ground up development? What point's the exit for your investors or for you guys? Is that pre-tenants signing leases, or is that after tenants are in, you hold the properties?
The greatest value for these assets is that you get to full occupancy, and then we realize an exit. That's typically 3.5 years to 4 years. A year to get permitting, sometimes less, about a year to construct. We're probably about 35 to 50% pre-leased at the time that the center opens. And then over the next 12 months or so, we'll get fully leased up. So our first 3 centers, 2 of them will likely exit in a 36-month time frame.
Very cool. How many centers have you completed at this point? What are the goals for you guys at Malabar Hill?
Along with just retail development, in these master plan communities, we would love to just buy 2 or 3 acre sites. But these developers oftentimes have a whole town center, which is like 10 acres. And so we'll take on what we call horizontal or land development. It's not as if it's like a raw piece of farmland, but basically the last mile of horizontal development, whether it be bringing in water or sewer or what have you, and we'll sell off a balance of that land to users. For example, we have national fast food chains that are looking at our pad sites, an auto parts, daycare, gas stations, and they pay a premium because we've taken a wholesale piece of land, improved it, and then they'll pay a premium. That's a way to bring value back to our investors. And then the remaining portion, 2, 3 acres, we'll do our retail development, which is our core competency as it would be.
You said your partner is a developer who's been doing this for about 20 plus years as well. Is that correct?
Absolutely.
Yeah.
He's built hotels, climate control storage, built shopping strips, build a suit. If it's like a building that is just a single user, like a restaurant, he's done that as well. And he's done it in different municipalities in and around Houston's market. And particularly, he's also done it within master plan communities. We should understand that when you develop, you have municipality rules, but in master plan communities, you also have architectural review for these master plan communities. So there's this added level of development and skill that's required. A lot of people don't want to have to deal with that. You know, with every type of hurdle, there's value. That's what I tell people. There's not really a day that goes by that I don't get a phone call, when is your shopping strip ready to be sold? We know there's a lot of buyers on the back end. That's very comforting. Our big job for our investors is to stay on our timeline, stay at or under budget, and then just execute. And that's what we do every day.
That's great. The bigger problems you solve, the bigger the reward. That's for sure. It's awesome to hear that's working out for you. What do you feel like has been kind of pivotal in terms of your partnership, or what would you recommend to someone who's like, I really want to get involved in real estate in some commercial form and I'm looking for a partner? What would you say makes a good partner or something that folks can look out for?
I would say probably more than anything else is asking yourself, what are you looking for yourself? I oftentimes hear from people, what's my tax benefit? I tell people that tax benefit's great. The project unto itself needs to have value, and there's value creation by the sponsor. So buying an asset and not creating and just holding it doesn't create value. There's 2 or 3 parts to real estate. That value creation is actually doing something with the real estate that you have. Financial engineering is not adding value to an asset. Value add happens from maybe doing something infrastructure wise or something, but just buying something, holding it, or buying it at a premium does not create value. At the end of the day, do not get into a syndication or a partnership where your singular goal is, I get depreciation and cost segregation. You want to create value, and value is created not by depreciation.
I've seen some folks that have kind of gotten themselves stuck between a rock and a hard place, more with kind of short-term rentals, just thinking through like, oh, okay, well, I can buy this short-term rental and do accelerated depreciation and everything will be great. And I'll get this huge tax write-off, which is awesome. But like you said, that's just one piece to the puzzle. And if you're buying a short-term rental that's not going to necessarily have much occupancy or the average daily rate's low, or you're not going to be able to make that much income. And then you're paying to keep this house, but you then just only got into it for the tax benefits to begin with. Doesn't really make a whole lot of sense. It's definitely one key to the puzzle, but you need to factor in all the different ways you can make money in real estate. That's not just taxes. But I do feel like taxes, depreciation is really sexy right now since interest rates are high. Kind of thinking about all the different ways that you can make money in real estate is very important.
And that's what I'm trying to say. We're developers, so our assets aren't immediately cash flowing. I can't give those type of benefits immediately. If we hold on to the assets a little bit longer, of course, but I have to give higher yield because we're building something at cost and we're selling it at a premium. There's almost a 200 basis point spread between my ingoing and outgoing cap rate. It's just the nature of the retail business. We should add a couple of things about this retail, and the nature of retail is that they're triple net assets, meaning people listening to this podcast means that all of the operational expenses, say taxes or insurance, and now we want to be good stewards to our tenants, but it's still passed on to them. We don't absorb that into our leases. The other part is that our leases are very long, 5 or 10 years with multiple year extensions and annualized rate increases of typically 2.5%. You can't increase it by 6 or 8% per year. There's not a lot of highs and lows, but I don't like highs and lows in real estate. They're just very steady net operating incomes over long periods of time.
Steady, stable, secure, backed by a large company. I'm sure that this isn't the first store that they're opening. With it being a triple net lease, they typically have some experience. And what a great way for you to have that security as well on your investors. What's been some unexpected kind of problems or holdups that you guys have had with this development project?
I would say in development, hurdles are more common than not. That's just development. There's going to be unseen issues, as it would be. I can tell you, for example, there was easement that was not on our survey at the time of close. We had to reroute water to the adjacent building, and we had to do that in the middle of the night on a Sunday. It was an added cost, but we still came under budget on that building. Because of COVID, electrical transformers were a little behind. It took an extra 120 days to get certificate of occupancy on a building. I would say that the most experienced developers build all those contingencies. I mean, not everything, but you build contingencies into your pro forma so that you can interest and operation carry your project. Like I said, I like my projects. Most of the loans that we have are about $4 to $5 million. The rest of it sits on the equity side of our projects. If we have so much interest reserve and operational reserves baked in, and I'm willing to do that. I'd rather take a lower IRR for our project and over-deliver than under-deliver. And that's just where experience counts. Typically, greenfield projects or ground-up projects will over-deliver over time just because we have so much contingencies baked into our projects.
That's good to have that security. I feel like it's way better to over raise or over capitalize and not have to potentially ask for a capital call down the road. And I feel like investors probably appreciate that and having that extra security there, which is awesome. You said, and correct me if I'm wrong, it takes about 3 to 5 years for a project to kind of go from the dirt to being completely filled with tenants. Is that correct?
Yeah, I mean, 5 years would be on the long side. Typically, it's between 3 and 4 years.
Okay.
We're very mindful about oversupplying a particular trade area. We typically will not be much over 25,000 square feet. If we're going to do 25,000 square feet, we probably are, and we have an active project like that, but it's a signalized intersection that has 30,000 cars in front of it, and it's at the entrance of a 3,000 acre community. In our gap analysis and our feasibility, we can absorb that much square feet. But that's about the largest we will do unless we're just on a main highway.
What are some businesses that you guys look for in terms of tenants? Is there a specific industry that you target mostly for
We
tenants?
have our landlord. We have leasing reps that we work with. It's funny. Sometimes people ask me the exact same question. I say, have you gone to a shopping strip in the last 2 weeks? And they're like, of course, we go to them like every other day. And I said, there you go. You understand my business. I'm not telling you anything any different than what we do. If you've gone to a Starbucks or gone to a Dutch Brothers, or if you've gone to any food concept that's in a shopping strip, whether it be pizza or Jersey Mike's is on my list because we're getting an LOI from one of our sites. We have an LOI from dentist or orthodontist, nail salons, boba tea concepts, fitness concepts. You name it, there's probably 1,000 type of users depending on what geography that will go in there. And that's what I love about it. It's a B2B business. And often these businesses, a lot of them are franchises, so they have a national name, but local franchisees, this is their heart and soul. And so as tenants go, it's everything for them. They have their net worth in these businesses and they take care of their spaces. It's very important for them. And that makes it that much easier to manage your asset. It's not that someone is up space because that's their business. And outside of that, to the next point, it's not that difficult after it's fully leased up to manage it because, like I said, we're not taking care of the leasehold space, the tenants are.
In terms of like tenant improvements or kind of the build out for the tenants, do you guys kind of build that custom as you go? Like you already have tenants that have signed a lease and they're going to be in these specific shopping centers? Or are you guys already kind of retrofitting that unit for them as you do the build?
See, that's the beauty of it. We don't do any of that. We build a shell and then we parcel up depending on how much the user wants. We put a demising wall in and they're responsible for their build out. They're improving our building as it would be.
Right.
So we give them what we call a tenant improvement allowance. For example, it may be $30 or $50 depending per square foot, depending on what type of user. Food users typically need more because they're doing more improvements, whether it be kitchen or plumbing infrastructure. But like I said, at the end of the day, they're improving our building. They can't take those improvements with them if they leave. And the beauty about like food users, for example, is we always want our tenants to be successful and robust businesses. But as you know, businesses do go out of business. But food users, there's a whole host of people looking for second generation sites. So typically, particularly food users or built out tenant improved areas are pretty easy to lease out again.
That was going to be one of my follow-up questions. How difficult or how long is the timeline typically to get a new lease started if someone were to leave? What's that typically, that turnaround time look like?
We do mainly new builds. And so literally when the last lease is signed, we're already looking at strategies on how to exit that asset, whether it's the public space or off market or a 1031 buyer looking at our asset. Or what we're even most recently contemplating is that it takes so much effort to take these out of the ground. It is the greatest value to just continue to hold on to the asset. And so we're looking at a stabilized fund for our now completed shopping centers. As we start getting close to that point of exit, we'll share that with our investors, kind of decide what we want to do. Some may be along for the long journey and some may say, look, hey, we would like to recycle our equity dollars into newer projects.
Probably enormous tax benefits as we hit on beforehand with that too, with holding on to those long term. Well, that's really cool. I'm just thinking about a way, how can I buy a shopping center that has a Chipotle in it and get Chipotle for free forever? That's what I'm thinking about right now from that perspective.
There's some irony with Chipotle. I would love to have Chipotles in our shopping strips. There's a lot of potential with the Chipotles. Chipotle, Starbucks, some of these really large corporates, they have a lot of building requirements. So sometimes, just sometimes, not always, it's a break even, if you can believe it. Having said that, Starbucks and Chipotle would be fantastic to have in your shopping strips. That's not always the case, but I would tell you that at least for our first 3 shopping centers, I performed for today's or Class A leases back when we started in 2022. And I have never signed a lease less than my pro forma. And so leases continue to slowly but surely rise. And that's because there's a supply-demand mismatch right now. With the cost of capital, not every project is penciling, but the ones that do, you should certainly contemplate doing. That's why we continue to find really good sites and continue at least taking on the best projects.
That's awesome to have that ability to select the best ones and go from there. That's definitely key. How, kind of going back to the initial or the beginning, do you guys reach out to these master lease communities and say, hey, we want to buy a parcel of this land and sell it to you? Or how do you find the initial ground to do the development for?
You have to be really in the space. We have our brokers They're just kind of have to have their finger on the pulse of every master plan community. There's some timing issues too. You don't want to jump in too early because then there's not enough rooftops to mark a driver's pool what you're trying to bring out of the ground. We're not the only developers in the space, but it's just kind of constantly surveying the market. That's a part of what we do literally every day. I would not be lying to you if I said I'd probably put 25,000 miles on my car a year. We're just driving. A part of thing is that you have to look at your real estate. That's another thing about investors. I don't like buying stuff that I can't see. I don't like building on sites that I can't drive very often. We have 2 projects in Austin, but we're constantly in Austin, even though we're in Houston. There's not a lot of activity right now because we're in the permitting phase, but once we start building, it's going to be a weekly process, particularly for my partner who's boots on the ground. I don't envision us going much further than our 200-mile radius, honestly. And I encourage all investors, they should look at exactly what they're building or buying.
Yeah, right in your backyard sometimes is the best investment to make. And sounds like really working well for you guys in Houston and Austin. Anywhere else in Texas that you guys are looking at in particular?
As we scale, we're just being very measured at how we kind of roll it out. We need to exit our first 3 projects. We want to ensure that our initial investors want to come full cycle. And then we have old investors, or I should say our initial investors, and we have newer investors. Part of talking about Malabar Hill is in our newsletters, we tell everybody about all the projects so they understand the life cycle, because development is a patience game. It does take time. We have one project where it's been excruciatingly long with the municipality. But having said that, I truly believe the investors, the hardest projects are going to make the most money. And the leases are coming along nicely, even though we haven't put a spade in the ground. We're just doing infrastructure. It just took that long. It took a year longer than we anticipated. Let's put it that way. Now, the equity is perfectly safe for our investors because it's sitting in land, but it is patience because you're like, what's happening next? Particularly in development, there's a lot of things happening that are unseen. Architects, engineering, municipality meetings, all of these things are happening. Funny enough, I think as us as physicians, and me particularly, I'm an emergency medicine physician, we're always thinking in seconds and minutes. It's a challenge. That's probably the hardest thing about real estate. That transition from medicine and the decision cycle is in 3 to 5 minutes here with a critical care patient, maybe even seconds. And real estate's like months.
Get rich slow for sure is the name of the game. Well, thanks for adding another shiny object for me to stay up thinking about, because this is also, I want to be respectful of your time. Is there anything else you'd like to hit on or any other points that we'd like to discuss?
I think the most important thing is, particularly for physicians, diversification is extremely important. I encourage my investors, when they ask me about how I invest in real estate, is that cash flowing assets are very important. I know multifamily is very challenging right now, but multifamily is a fantastic asset class. It's really an interest rate issue right now, and it will recover. Find the best sponsors for whatever asset classes you're in. Your cash flowing assets, but consider money in the development side as well, or at the very least in retail as well, because it honestly is the same investment thesis, which is where home sites are and where people live. These unanchored retail shopping centers will always exist. That's probably more important than anything else. And then for anybody who's listening, feel free to reach out. I find my biggest role for my investors is just educating.
You've definitely educated me a lot during this podcast. I'm sure everyone listening too. It's a really cool asset class and a really cool opportunity. Is there a good place for folks to reach out to you and learn more?
Yeah, absolutely. You're welcome to email me, Mounang, MOUNANG at mhcapital.org. I welcome you to look at our website, and you can find our contact information there. And if you're interested in some of our projects, you can find those also on our website. We'd love to hear from you all.
Awesome. We'll be sure to put all those links in the show notes and get folks connected with you. I really appreciate your time today. Thanks for coming on the podcast.
Hey, thank you, Alex.
With that, it's been Dr. Mounang Desai and Dr. Alex Schlow with another episode of the Physicians and Properties Podcast. Signing off. Hey, real quick, if you're still listening to this, I'm assuming you got value from it. So I need your help specifically. My 2-year vision with this podcast is to help 100,000 physicians learn how investing in real estate can give you the freedom to practice medicine and live life how you want. There are 2 main ways that a podcast grows. One is through ratings and reviews, and the other is word of mouth. If you can please leave me a 5-star rating and review on Apple Podcasts and Spotify, as well as send this to 1 to 2 friends that you think would get value from it, we can reach the physicians that we want to reach. Thanks in advance, and talk to you on the next episode. Please note that the information shared on this podcast is for informational purposes only and should not be considered financial or medical advice. The views expressed on this podcast are those of the host and the guest and do not necessarily reflect the views of the Department of Defense or the United States Air Force.